So today we're going to be talking about how to find the value of a stock. And this has been one of the most requested videos on my channel, mostly because of the content I've been putting out lately talking about being a value investor and talking about some of the great lessons from the intelligent investor and talking about trying to find the value of a stock and then buying a stock or investing in something when the price is below the value. So the question I've been getting is, how do you determine the value of a stock? And it's tricky. There's a lot of different ways to do it, but I'm going to give you 6 things that I look at when I'm trying to determine the value of a stock. So, as you know, if you've watched my videos previously, the price of a stock swings between optimism and pessimism. That's straight out of The Intelligent Investor. Again, if you guys are looking to learn about investing, that's the #1 book I recommend, and it's linked up in the description. But the price always swings between pessimism and optimism, neither of which is sustainable. Value investors buy from the pessimists and sell to the optimists. So you are greedy when others are fearful and fearful when others are greedy, in the words of Warren Buffett. So value investors are looking to buy when the price is below the value. The thing is, the market prices a stock wrong from time to time, and this is due to a number of reasons. It's an overreaction. If there's one thing that's consistent with the stock market, it's an overreaction. This can be in either direction. It can be an overreaction to good news or an overreaction to bad news. You'll see this frequently because, as we said, the price of a stock swings from pessimism to optimism on a pendulum. So you're always going to see stocks that are overly optimistic and stocks that are overly pessimistic. But what causes a stock price to get out of whack? First of all, there's disappointing earnings. So if a stock reports quarterly earnings that disappoint investors, you will see that stock fall in value. For those of you who saw what happened to AMD stock on their quarterly earnings in May, you are familiar with what I'm talking about here. An industry or market correction. So if the overall industry is doing poorly or if the overall market is doing poorly, this will drag down the stocks themselves as well. Any bad news surrounding the company will trigger this as well as economic and business cycles. So there are cycles within an actual business. I mean, for example, you got to think certain stores do better during back to school. Certain businesses do better in the summer. Certain businesses do better closer to Christmas. So there's different things. Those are business cycles that will affect the stock price. And all of these things oftentimes push a stock below the actual value. It pushes the stock price below the actual value of that investment. So as a value investor, you're looking to find the value of a stock and then buy it when the price is below the value. So how do you find the value of a stock? There's 6 things I'm going to show you guys. #1 is the price to earnings ratio. This is the one that most people are familiar with. This is also known as the PE ratio. To determine this, you basically take the current share price of the stock divided by the annual earnings per share. Obviously, earnings per share would be the total earnings divided by the outstanding shares. That would give you earnings per share. So the best way to look at price to earnings ratio is what you pay for $1 of company earnings. And it's used to compare companies within a sector. This is one of the biggest mistakes people make, is they'll compare the PE ratio of a tech stock to a utility stock. You can't do that because every industry has a different PE ratio. So the best way to use the PE ratio is to determine what the average PE ratio is of that sector, and then compare the PE ratio of one company to the sector or industry average, and then to another company to determine whether the price to earnings ratio is above, equal to, or below other companies within that sector or the sector average. Now, the problem with the PE ratio, one problem anyway, is that it does not work for a company that is losing money. They will have a negative PE ratio or they will have no PE ratio at all. And then if you look forward or backward, you do have the trailing PE and the forward PE, which are also useful metrics when looking at the value of a stock. But we're just going to focus on the regular old price to earnings ratio because I didn't want this video to be half an hour long. So I'm going to give you guys an example of how to calculate a PE ratio. We're going to look at Apple, for example. And you don't need to calculate this stuff, guys. If you just Google Apple PE ratio, you can find it on Yahoo, or I think it's right on the homepage of Google there when you're searching for a stock. So you don't need to do this, but I want you guys to understand where the number comes from. So we're going to go through the actual examples. So let's take Apple. So we're going to look at the last 4 quarters for Apple as far as their earnings per share. So over the last 4 quarters, they've reported $1.69, $3.36, 210, and 167. So right there we see a perfect example of a business cycle. Obviously, whatever quarter that was, Apple made a lot more money, so that is the cycle of a business. That's one example of business cycles which can cause stocks to become undervalued. The total between these four will give us our annual EPS over the last 4 quarters, so that gives us $8.82. And if we take the current share price for Apple, which as of August 2nd closing was $150.05, divided by the annual EPS, that gives us a PE ratio of 17.01. So what does that mean? That means you need to invest $17.01 in order to yield $1 of company earnings. That is what the PE ratio means. So you would take Apple's PE ratio and compare it to other companies within that sector, as well as the average PE ratio of that sector to determine whether or not shares of Apple are more expensive, equal to, or less expensive than other companies out there. So number 2, the second thing when determining the value of a stock is to look at the price to book ratio, or the PB ratio. It's very similar to calculate, but instead of using the annual earnings per share, you're going to be using equity per share. So you take the current share price divided by equity per share, and if this figure is below 1, it means that stock is trading less than the value of the actual assets, and if that is above 1, it means the stock is trading at more than the value of the actual assets. Let's look at the Monster energy drinks, for example. This is the Monster Beverage Corp. So their total equity is at $3.53 billion. So to calculate the actual equity per share, you have to take their total equity divided by outstanding shares, which gives us a price of $6.22, which would be the equity per share or book value. Again, this is something you can just Google. If you search for Monster Beverage Corp book value, it's going to give you this figure, but I just want you guys to understand where that number comes from. So then if you want to actually calculate the price to book ratio, you would take the price for the share, you would take the share price, which as of August 2nd was $53.12, divided by that actual figure there, the equity per share, and that gives you an 8.54. So that means shares of Monster Energy Corp are trading at 8.54 times the actual book value of that company, or the actual equity per share. So you would use this to compare the multiple on the company assets between companies of the same sector. So the third thing I like to look at is the price to earnings to growth ratio, or the PEG ratio. To calculate this, you basically take the price to earnings ratio and divide it by the projected 5-year earnings growth rate. Again, you don't need to calculate this yourself. You can find the PEG on Yahoo Finance, or a couple of different places you can find the PEG. So you don't need to sit there on paper and write this out. I just, again, want to show you guys how this is actually calculated. This is a good metric to use for a company that's experiencing rapid growth. It's a good way to determine whether the current PE ratio is justified or if the company is overvalued. And if you find a PEG below 1, that company is undervalued. What I will tell you right now is, with the current economy we're in, with this bull market, it's going to be very uncommon to find a company with a PEG below 1 that's a sound investment, simply because many stocks are fairly valued, if not overvalued, because we are in a very highly valued market right now. If you're in a bear market, it's much easier to find value. So actually the best time to go value hunting is during a bear market. The more overextended a bull market becomes, the harder it becomes to actually find value. So if you're someone who's looking for a value investment and you're not finding anything, it might be because we are in a bull market and it's very difficult to find a stock that is a good value, that the price is below the value. But once we're in a bear market, they're all over the place. So that's actually the best time to go hunting for value. So for example, let's look at a company that is going to be seeing rapid growth. Let's look at NVIDIA. So currently they have a price to earnings ratio of 55.64, which is quite high. And they have a 5-year growth rate of 13%. So their PEG would be that 55.64 divided by 13, so 4.28. So that's nowhere near that 1. It's not below 1, so this is not undervalued, meaning that much of their growth is factored into that share price. So if you look at the PEG, that's kind of high. That's a little bit higher than I would be comfortable with as far as price to earnings to growth goes. And then you can again take this metric and compare it to other companies to see whether or not their actual growth is factored into that share price yet or not. The fourth thing to look at is the return on equity. This is the annualized net income to shareholder equity, or in simple terms, how well a company uses investments to generate growth in earnings. So these are the general guidelines that people follow. There's no set standards, But 17 to 20% is considered very good, 20 to 25% is excellent, and if a company is generating above 25%, that is superior. The best way to look at this is the average return on equity. Just for examples, I pulled the ROE of 3 companies as of March 2017. But to get a better snapshot, you would look at their average ROE or maybe their return on equity over the last 1 or 5 years. But just for example, Amazon's return on equity for March of 2017, for the quarter ending in March of 2017, was 14.34%. Samsung's return on equity was 16.56%, and Intel's return on equity was 17.62%. So you need to figure out what your criteria is for this and what you're looking for. And if that company doesn't have a return on equity that you are comfortable with, then that would be a company you would not invest in as a value investor. The fifth thing to look at is the debt to equity ratio. This is the total debt divided by the shareholder equity. And the lower the better, and you want to avoid any company with a debt to equity ratio above 2. So I took Google, which is one of the best companies as far as their debt to equity ratio goes. As of June of 2017, their report for June of 2017, they have $3.955 billion of debt on $148.286 billion of equity, giving them a debt to equity ratio of 0.0266. So that is nowhere near 2. That is a very low number. That is a fantastic debt to equity ratio. So you want to look for a great debt to equity ratio. That's probably as good as they're going to get. Number 6, we have their current ratio. This is very important too. It's also sometimes called the liquidity ratio. This is a measurement of the ability to pay short-term and long-term obligations. This is a very simple one to calculate. You divide the liabilities from the assets. Now this is an interesting one because you want it to be within a certain range. You don't want it to be too low, but you also don't want it to be too high. So if the current ratio is below 1, that means the liabilities exceed the assets, which is not a good thing. If the current ratio is above 1, that means the assets exceed the liabilities. However, if the current ratio is above 3, that might mean they're holding back. They could actually have a little bit more liabilities and be more invested in the business. That might mean they're actually holding on to too much cash at that point. Usually what I look for is a current ratio of 1 to 2. So let's look at AMD, for example. This is just something you would search for. You would search like AMD current ratio and you'll find that number. But as of March 2017, they had a current ratio of 1.82. So that falls between 1 and 2, which is what I look for. That's a good current ratio. So what you're going to do with all this, because this is a lot of information, what I recommend you do, you figure out after doing some research what numbers you're looking for and you'll create a checklist. So then when you're out there hunting for value, when you're looking at a stock, you're going to go through and you're going to look up all these metrics. And if they meet your criteria, you add them to your list. And if they don't meet your criteria, you say, well, I don't think there's value in this company. And you may not find companies that meet every single piece of your criteria here, but you're going to look at them each individually. And there's also other factors to consider as well outside of just this fundamental stock analysis. So I might actually do a follow-up video talking about what that would be. But you're going to kind of just look at this and you're going to look for the best possible scenario. You're going to look at the companies that meet most of your requirements. So maybe your checklist would look like this. You want to look for a company with a price to earnings ratio below the sector average. You want to find a company with a low debt to equity ratio. You're looking for a return on equity of 17% or more. That's considered very good. I mean, if it's in the 20s, that's fantastic. You're looking for a current ratio of 1 to 2. They have a responsible amount of liabilities, and they're also not holding back. You know, they do have a good amount of debt, and debt can be good because that is helping them grow the business. And then you're also looking for a reasonable price to earnings to growth ratio, as well as a price to book value. And this is how you are a value investor. You're looking at things like this and determining whether or not the price is above the value or the price is below the value. There's a lot that goes into this. This is certainly no easy task, and there's multiple ways to actually do this. You guys can figure out what metric makes most sense to you, and there's also other ones you can use. These are just the ones that I look at when I'm trying to determine the value of a stock. Anyways, guys, I hope you enjoyed this video. I know this one's more technical than what we usually get into here, but you can do more research on each one of these things on their own and learn more about them. If you enjoyed this video, please drop a like, and if you are new to my channel, please consider subscribing to be notified of any future uploads. And as always, I thank you for taking the time to watch this video.